Okay, so today I'm going to be talking about COVID-19 and international trade. And Shayla gave us a nice summary of the kinds of disruptions we've seen in global interconnectivity, whether it's moving people, goods, or services across borders. And I'll talk a bit about what I see as the macroeconomic environment, the role of trade in that macroeconomic environment, and what we see happening in the trade area in terms of COVID-19's impacts. One of the things I do want to focus on is the potential implications for globalization and long-term economic growth. As Chief Economist here at the WTO, one of the things that I find most challenging is ensuring that trade negotiators, delegates from member countries, spend a little bit more time thinking about the future evolution of trade, not just negotiating agreements on the way the world or trade has been in the past 10 to 15 years. I find that to be a weak point for many trade negotiators. So getting started here, the global economic outlook is exceptionally uncertain. This is OECD's recent interim economic outlook. It came out 2 days ago, I think. And you can see that compared to their November 2019 projections, September 2020 projections show a pretty significant decline in the outlook for global growth between now and the fourth quarter of 2021. Now, because there's so much uncertainty here, and you'll see this later when I present the WTO trade forecast, they've done an upside scenario and a downside scenario. So even on the upside scenario, where the recovery goes relatively well, we still are likely in 2021 to remain well below previous trend growth. If things don't go very well, if we experience more of what's called the downside scenario, you're going to see us well below the previous November 2019 projections. In terms of the distribution across countries, you can see, I'm going to focus here a bit on India. And you can see that in 2019, India had growth of about 4.2%, but the projected growth for 2020 is minus 10.2%, with a recovery of 10.7% in 2021. That does not get you back on track with 2019 growth trends, but it gets you back closer. You can see many countries are experiencing rather significant economic downturns. They project for the world a decline of global GDP of about 4.5%. In the great financial crisis of 2008, 2009, it was about 0.2% globally. So you can see that this is quite a significant negative shock. And, the IMF will be coming out with their World Economic Outlook, providing a GDP forecast update on October 13th. But as of today, we see GDP growth across international organizations, whether it's World Bank, IMF, WTO, OECD, and the uncertainty ranges anywhere from -2.5% to 8%. And I say this is presented in our June meeting. This was a meeting of the G20, and these slides that I'm showing you, I'll be presenting tomorrow to the G20 Trade and Investment Working Group, and then later in the week to the G20 Framework Working Group. So this is the very latest information that we have. So what are the current macroeconomic policy priorities? Well, this is the deepest global recession in 80 years, despite very significant and unprecedented policy intervention. We've had massive interventions in both the liquidity side and the fiscal policy side in most large countries, and particularly the developed world. We expect that per capita incomes in the vast majority of emerging market and developing economies are expected to shrink this year, reversing this long-term growth that we had, where we saw a global convergence We expect, and global reduction in poverty, we expect to see many millions tipping back into poverty as a result of this crisis. So what are the likely long-term implications of the pandemic? Well, we expect weaker potential output, weaker investment, and weaker productivity over the long term, a slow recovery and long-lasting effects, disproportionately affecting the most vulnerable people. That's the most vulnerable people in the developed world and in developing countries and least developed countries. So the policy priorities are address the immediate health crisis. That's the highest priority. Pursuing reforms that will reignite inclusive and sustainable growth. And if any of you have questions on this inclusive thing, I'd love to talk about it later. We need to work on transparency around debt and investment. We need to strengthen global cooperation, and this is one place where my main institution, the WTO, has often been viewed as a preeminent organization for global cooperation, but that cooperation has broke down in the last few years. And then we need to find ways to enable resilient supply chains. So what are some of the major trade developments? Well, preliminary trade data show world trade slowing sharply in the first half of 2020. OECD shows that global merchandise trade declined almost 18% in May, but rebounded to only a 10% decline in June, while the World Bank suggests global exports in value terms are about down 10% year on year. Note that rebounding to a minus 10% is a rather stunning statement. That's still a pretty significant decline. And I think there's a lot of uncertainty. Many people are looking at some recent trade data coming out of China and getting very optimistic that that signals a global recovery. I try to remind people that increased exports coming out of China are dependent on increased demand or sustained demand in the rest of the world. And I see very little indication of sustained demand. My suspicion is that increased or that rebound of trade in China has much more to do with inventory rebuilding and stockpile building by many other countries, much less to do with sustained demand. So the outcomes for the year will very much depend on how economies perform in the fall and early winter. Goods trade has suffered from a general drop in demand and a negative supply shock because of the lockdowns, but it's also benefited from aggressive fiscal and monetary policies in many countries, including the recovery in China, benefiting from aggressive fiscal and fiscal policy in the United States and the EU, which has allowed for the continued sale of things like televisions, white goods for households and other consumer products. The question is how long will that be sustainable? And we've also seen goods trade supported by a shift in demand away from proximity-related services to spending, which are mostly not less tradable. Things like hotels, restaurants, travel, music, events, plays, movies, things like that. Some of that savings from the reduction in expenditures on those did shift towards manufactured goods, and specifically related to things like medical equipment and goods related to working from home. This is why we see a recovery in a lot of electronic goods related stuff. I've been a purchaser of some of those kinds of things. Services trade, which lagged merchandise trade, showed sharp declines in May. Global services exports fell about 28% year on year, and imports by 33.2%, driven largely by reductions in travel and tourism. And we've seen a decline in international tourism arrivals of about 98% globally year on year. Commercial flights have started a slow increase in some countries. Air cargo remains capacity constrained, and air cargo rates have increased substantially. Passenger planes carried a significant share of global air cargo, and with a reduction in civilian passenger airplanes, that cargo has had to find other sources to fly. Container shipping has started to come back a bit, and some would argue that it's fully recovered. I think some of that is a shift of this air cargo towards container shipping. And again, we'll have to see if that's that return of cargo shipping has to do with inventory rebuilding or if it's got to do with sustained demand. If we look at global value chains, the World Bank Group has looked at elements of global value chains. And if you look at this particular export chart here, you see that there's been a recovery in intermediate goods, that's this orange block, and passenger motor vehicles, this light blue block up here, consumption goods, and also some capital goods. So those are good signs, but many of those things strike me, particularly passenger vehicles and some of these consumption and intermediate goods strike me as the kinds of things where inventories were depleted back here when exports declined, and some of this could be inventory rebuilding. So a key question is what's driving this short-term recovery, temporary factors or something more sustained. Some more data here, and you can see that there was a much bigger decline in, say, April and May for exports and imports, with a smaller decline in June. And it was late May and early June when many countries started to relax their health restrictions, and we saw economies start to recover. It'll be very interesting to look at what happens for the rest of the year. On October 6th, I believe, we'll release our trade forecast update. And this is our current trade forecast. And you can see we have an optimistic scenario given by the green bar here and a pessimistic scenario given by the red bar. So instead of an upside and a downside, we called ours optimistic and pessimistic. And right now, the data seems to have us closer in 2020 to the optimistic outcome, where we had trade declining by about 12.5%. The pessimistic scenario was to reflect a decline in trade on the order of magnitude relative to GDP decline of the Great Depression in the 1930s. We don't see that outcome. So our pessimistic scenario seems not to have occurred. However, the green dotted line indicates that now, as we're looking forward, this was from our June update, we don't think we'll have this optimistic recovery, but we'll have a recovery that gets us more in line with our pessimistic scenario. And I can talk more about this if you want. But essentially, we don't see getting back to on-trend growth in 2021. We create these real-time indicators that are based on more real-time data rather than traditional data series. We look at things like drivers of goods trade, export orders, automotive production, container shipping, air freight, electronic components, raw materials, and our trade barometer, which is a measure of momentum for trade, shows a steep drop in trade, but there are some hints. You come over here, world merchandise trade, you can see that the world merchandise trade in June and July started to level off a bit. However, many of these other leading indicators remain very, very weak. And so you can see that between May of 2019 and June of 2020, for automotive products, that these were this weakened some. So yeah, we have significant concerns around a number of the drivers of goods trade. We do a services barometer that was just released yesterday, I believe, and that also came in below trend. Not as weak as goods barometer, but an interesting thing about services trade is that for a number of years now, services trade has been growing faster and much stronger than goods trade. And this is the first time where we've had our services barometer drop below trend. So what are, that's the current situation, macro and trade situation. It's pretty mixed. A lot of uncertainty here going forward. So I think many of us working in international organizations who provide advice to governments are going to be paying very close attention to the development of a number of data series, including increasingly what we call real-time data, big data, not just the traditional historical monthly or quarterly data series. So what's the summary of COVID impacts and implications for global trade? So kind of abstracting or stepping back from all of these shorter term indicators. So I think some of the big drivers here are going to be psychological. What's the impact on consumer business and businesses' confidence and habits? Will we see consumers resuming consumption and firms resuming investment? My guess is no. I think we're going to see both consumers and businesses very hesitant for the next year, and it will take some significant confidence building steps to get both consumers and businesses to return to pre-pandemic consumption and investment patterns. Now, this will vary by country. It'll vary by sector. We've got both sort of aggregate trend developments, but also compositional developments happening. But I do think overall, I'm pretty pessimistic about a V-shaped recovery where we get right back on previous trend track. I just don't think that's going to happen. I think we're likely this fall to see what we call a W-shaped recovery. We see this little blip in the last couple of months, but it very well could weaken through the fall and into winter. So another challenge here is if government policies are either not large enough or structurally ineffective at bringing about the kind of sustained confidence and expenditures by consumers and businesses. They could be either not large enough or they could be structurally ineffective at dealing with the demand and liquidity issues. Is it better to put money in the pockets of consumers or to support businesses, to support investment, to support payrolls? These are very difficult questions, and governments have been taking a mixed approach. Some governments have focused much more on giving money to consumers. Others have focused much more on providing liquidity to firms to be able to stay in operation, and in some cases providing support for payrolls. Now, the big impacts on trade come from decreased consumption and investment, but also, and this is important, and I think Shayla was pointing out that there have been all of these breakages in the linkages in global commerce and the movement of people. Those have increased trade costs. Now, one surprising fact that I think many folks working in trade, I certainly know it's the case here at the WTO, when I try to tell delegates here that the biggest driver of trade growth is GDP growth, particularly investment as a component of GDP, usually followed by consumption. Government expenditures are the weakest element of, or the weakest trade driving element of GDP. But investment turns out to be very trade intensive. And if investment is weak, trade is generally weak. And then consumption is the next most trade intensive. Exports, by the way, are also trade intensive, but there's a lot more endogeneity there. So I think for trade to really recover, what we need to see is a recovery of consumption and investment. The increased trade costs are also going to play a role in decreasing trade. Cargo costs, particularly air cargo, has gone up significantly because of the declining capacity from large civilian aircraft not flying around the world. But also delays at border crossings, the inability of business folks to move around the world has slowed investment, but also increased their costs, believe it or not. There's a lot of cost savings to the intangible communication that can occur when business people who are setting up new operations, whether it's new machinery in a plant to be operated, often highly skilled technicians are critical in ensuring that that machinery is set up and operating efficiently. And if they can't move, there is increased costs of setting that equipment up. Now, there's also been a supply shock from reduced labor participation that has been mitigated by a number of the health measures that countries have taken. So the supply shock has not been as big as many people thought it would be at the beginning. It could recur this coming fall, but the big shocks have been on the demand side. So in particular, if there's a vaccine that can really help increase labor participation, given that capital and infrastructure has been undamaged, allowing workers to go back to work can, if there is enough demand out there, get the supply side running again. So what are the implications for globalization from all of these shocks? Well, when I first arrived at the WTO 6 years ago, people were talking about the decline in trade growth, that we had seen this very rapid rise in trade growth compared to income growth between 1990 and 2005, where trade growth was two times or greater than 2 times income growth. But I think it's unreasonable to expect to ever go back to that in any near-term scenario. That scenario was largely driven by countries like India joining the global economy through unilateral reforms and also trade reforms in the 1980s and 1990s. China's opening up and the opening up and reform in Central and Eastern Europe and the former Soviet Union. That brought billions of people who had been relatively insulated from global commerce into global markets, both on the supply side in terms of highly skilled labor, relatively low wage, but also consumers and a significant source of demand. However, I do think we'd go back to seeing trade, if it recovers from this pandemic and confidence is restored, returning to its much longer term growth rate from 1865 to present, which is trade growing about 1.4 times income growth. And I can talk about the sort of technical and mathematical aspects behind those numbers. I do expect to see much more digital cross-border trade. We're doing some of that right now. But there was a rapid increase in digital cross-border trade over the last 10 years, particularly with increased digitalization, the price of ICT goods falling dramatically, trade liberalization in ICT goods around the information technology agreement at the WTO, regional trade agreements. So we've seen this big long-term growth in cross-border digital trade that has spiked as a result of COVID crisis. Now, I also expect to see greater diversification in supply chain sourcing, more automation of production and supply chain steps, and more flexible production processes, both domestically but also across border. This will go with some of that diversification in supply chain sourcing, and I expect to see countries reaching agreements, particularly around the supply and production of critical goods, where they'll agree that should they run into a domestic supply shock, that another country not experiencing a supply shock will facilitate the trade of those goods to them. So what I see is a reorganization of globalization. It's reglobalization, but it's this reorganization of it with diversifying supply chains, increased digital trade, and more flexible production processes. Now, some people are very skeptical of this. They expect more reshoring or at least nearshoring. And by the way, that diversification in supply chain could involve more nearshoring. I'm fairly skeptical about the long-term prospects for reshoring or bringing production back in those large developed countries that have outsourced it. And that's largely because of Adam Smith's specialization and David Ricardo's comparative advantage. Those forces that focus very much on efficiency are still going to be very much at play. Now, firms, though, are going to change their weights and values on the cost of production disruptions, risk, versus efficiency. So things like WTO agreements, regional trade agreements, bilateral investment treaties, increased investment in trade infrastructure, the ability to improve the sanctity of contracts across border, all of those things helped drive all of this outsourcing and this ability of firms to focus on efficiency of production without worrying as much about risk. But I think the pandemic, as well as the trade conflict that we saw arise, particularly between the US and China, but not only the US and China, we had very specific examples of US-EU, Japan, Korea. There's potential uncertainty in the geopolitical sphere between India and China. All of those things are going to affect firms' views of risk and the potential for production disruptions. But that's a balancing act there. It's not going to just all of a sudden drive away any of the efficiency aspect. That efficiency aspect is still going to be there. So what are the long-term forces driving growth in trade? So I mentioned that macro matters and investment is most trade intensive. Liberalization policies, they account for about 25% of trade growth. What does this mean? That means if you sign a trade agreement and you see a change in trade flows in your country, either bilaterally or multilaterally, often, usually after the maybe initial realignment, what you see is that about 25% of that trade growth will be driven by the tariff changes. The other 75% is driven largely by those macro factors. When I was with the USITC years ago, I provided this kind of analysis to Congress, the trade committees in Congress, Senate Finance, House Ways and Means, and to USTR, and they were very unhappy with this. They didn't believe me, and then I put together a bunch of data that showed changes in US trade flows between countries for which we had free trade agreements or changed tariffs in one way or another, for some reason liberalizing them, versus countries for which we had no change in tariffs. And by the way, that would include countries like China, European Union, and Japan, and India. There's no free trade agreement with India. And the difference in trade growth, there was rapid trade growth in the US from all of those sources, and the difference between the two sets, the trade agreement set and the no change in trade agreement set, the difference in trade growth was about 25%. IMF, our research since then at the WTO has confirmed this finding. So why would you then bother with liberalizing policies if it's mainly macro growth? Well, I would argue you care about that 25% because it, along with the macro stuff, contributes to long-term growth. This is about shifting out your production possibility frontier. And anything you can do that helps shift out that production possibility frontier, that includes increasing labor and increasing capital, increasing the efficiency of labor through education. You're all university students, you're getting educated, you'll be more productive, you'll help shift out India's production possibility frontier. Improvement in your capital stock, not just increasing it, that will also increase out your production possibility frontier. But liberalization allows you to bring in lower cost capital goods, and IMF research has confirmed that liberalization in capital goods has dramatically contributed to the increase the decrease in the price of capital goods globally. You get foreign direct investment. All of those things help shift out your production possibility frontier, and it reflects the dynamic effects of trade liberalization, not those little welfare triangles that everybody often focuses on, and I've spent a fair amount of my career focusing on those welfare triangles for folks. But the big gains are these dynamic effects. Well, how does that relate to COVID? Well, I think COVID, particularly with this shock to trade flows, and if it's a slow recovery in trade flows, at the same time, you see a shock to consumption and a shock to investment, just strictly on the macro GDP demand components. That's going to lower your long-term production capabilities. and we will see years of lost potential growth. On the right-hand side, I have some graphs. In 2012, at the WTO, we did some scenarios on high growth, global high growth GDP and trade scenarios. The blue lines represent high growth scenarios, the solid lines for GDP, the broken lines for trade, and the red lines represent the low growth scenarios. So in the high growth scenarios, everything goes well, right? Good, high levels of investment, high levels of total factor productivity growth, high levels of education and labor force improvement, high levels of gender engagement in the labor force, and trade policies. There are no trade policy scenarios, so they remain at their relatively liberal level that we observed in 2012. In the low growth scenario, well, total factor productivity growth is low, investment's low, labor force improvement is low, gender engagement is low, and that's what gives us those two scenarios. The green lines, I hope you can see them, represent what's actually happened since 2012. And we've been much closer on both broad economic growth, GDP growth, and trade growth towards the low scenario. This reflects partly the weak recovery from the great financial crisis where capital markets locked up. And it also reflects, since about 2016, the trade conflict, increasing trade conflict and uncertainty. And now, unfortunately, what we're going to see is, as a result of the pandemic, that green line is probably actually going to go below the red line. Now, the longer that green line goes on, the less we have that blue line as a potential outcome. So we've had, since 2012 through about 2018, we had much less capital investment than we had anticipated in the optimistic scenario. And now with this global economic shock, we'll see another decline. So when we update this, that blue line will shift down because of the foregone productive capacity, and the production possibility frontiers have not shifted out, and they'll fall further behind as a result of the pandemic. So this future gap will grow in the future. So what are some of the mitigating risks for future pandemics, crises, and/or trade policy uncertainty? Well, we're going to see that firms, households, and governments will need to evaluate risk versus efficiency trade-offs. Risks for firms, I think we'll see they'll move from just-in-time inventories to larger inventories for critical parts. We'll see supply chain diversification. We'll see production being automated and digitizing. That's going to have implications for labor force participation and skill bias. And it's very much a risk versus efficiency calculation for them. Governments, how are they going to manage demand spikes above average supply? Because that's what we've seen here, particularly in health-related products. We're going to see them focus on building and managing emergency stockpiles, but they're going to have to do it in ways that taxpayers and citizens can afford and accept, because both the household balance sheets and government balance sheets are going to be very damaged as a result of the pandemic. And I think what that does is make this risk versus efficiency trade-off a little bit more difficult. Efficiency is still going to be very important. You're still going to want to be able to get these products at relatively low cost. And if you onshore production, you are not going to be getting the most efficient production. So, and I expect to see some flexible, so that's a role for trade, a role for domestic production and/or international insurance agreements, which will involve trade. We've already seen some of these at the WTO. We're also going to see governments increasing things around privacy and security around tracking and tracing for health-related issues. And, you know, in the global economy, we have quite a potential fragmentation in the global digital world. We have the Chinese model, we have the European model, and we have the US model. And it'll be interesting to see where India comes out in this. How much will privacy and security, particularly on the part of the individual, play a role here? And then There's a lot of uncertainty as to the requirements of the next pandemic or crisis. Will it be climate? If it's a health pandemic, will it be respiratory, or might it be some other kind of health pandemic? And this brings about this risk versus efficiency trade-off. Households are going to have to deal with things around remote work increasingly. Most of you students are experiencing remote education, and there'll be, again, issues around privacy, the ability to social distance and earn income, the ability to social distance and get access to critical services such as education and healthcare, and access to purchase necessary products while isolated. So this is going to be pretty big, significant compositional changes in the way these things work. So I'm going to try to summarize here. I have other slides, but I think I'll open it up for discussion. And maybe in that discussion, there'll be questions around what does the WTO do? And that's what most of my other slides are going to be. So, in the trade war tariffs, our analysis basically says those direct effects were small. There was those little deadweight triangles. They accumulate, but the long-term efficiency impacts and reallocation effects, those are much more likely to be larger than the direct effects. However, if the trade war tariffs dissipate quickly, then we wouldn't see lasting efficiency impacts and reallocation effects. But if we see the trade war last longer or even increase, and we see spillover effects, long-term spillover effects from the pandemic, then we're going to see that long-term, slower, long-term potential growth. So those indirect effects are potentially very large for investment and consumption. And we've seen that even in the tariff war, the trade war, but now with the pandemic, often these effects can be offset or diminished by fiscal and monetary policy actions. This, by the way, was a big issue around Brexit. The initial impacts of Brexit weren't as big as people thought, and that's because the UK government undertook, they rolled back their fiscal austerity and they eased monetary policy. And in the short term, that offset a lot of the uncertainty arising from the as to what the trade relationship, which we still don't know, between the UK and the rest of the EU would be. These COVID impacts are very large compared to the trade war. Not only do you get the policy uncertainty, but now you have this broader economic uncertainty. I briefly mentioned the fragmentation of global economy into blocks, these digital blocks. This could be very significant negative impact on long-term growth. Well, I'll stop here. I think I've been going on for about 40 minutes, and I'll stop here and happy to take questions and see where we go from there. Thank you very much.